Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. In this video we will be doing an analysis of the recently IPO'd Cava and seeing if it would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Now, let's go ahead and jump right in. Cue the logo. Let's start with some background info on Cava. Cava was opened in 2010 by three friends in the Washington, D.C. area with a mission is to bring heart, health, and humanity to food. Cava's menu features a variety of Mediterranean dishes, including salads, bowls, wraps, and pitas. The company sources its ingredients from local farmers and suppliers and recently IPO'd at $22 per share on the 15th of June, 2023. There has been much in the media about Cava being the next Chipotle, so let's take a close look. Since Cava's IPO, the share price has risen to a high around $57 but has since trended downwards. Given that this is a newly IPO'd company, future price direction is unclear. Now, let's take a look at the fundamentals. Gross margin is a very healthy 35%. Revenue has compounded at around 18% over the past 3 years and has reached nearly $645 million most recently. Cava has good revenue growth and solid gross margins. This is a sound company so far, and surprisingly, free cash flow is negative and has been worsening at a -27% CAGR over the last 3 years, while capex has increased at a CAGR of 73%. Change in stock-based compensation is negligible, as a new company firmly in the high-growth stage of its life cycle. Cava is and will be spending a lot on capex for infrastructure and expansion. Weighted average shares outstanding have grown at a whopping 735% CAGR, going from 200,000 shares in 2018 to 6.3 million shares most recently. However, it should be noted that CNBC lists the number of shares outstanding as nearly 115 million, so there is some discrepancy in the data. Either way, shares outstanding have exploded upwards due to the IPO, and it is likely that the share count will continue to rise in the near future as many early companies finance operations through additional equity offerings, further diluting shareholders. Given that this is an early company, there is no return on invested capital just yet. However, we can look at cumulative retained earnings and compare that with the enterprise value to get a sense of how much value has been created in the company thus far. Cumulative retained earnings are -$1.3 billion while the enterprise value is $4.7 billion. This means that Cava has generated $3.4 billion of value from $1.3 billion of investment, so the return on investment, not to be confused with the return on invested capital, is 2.6x. Not bad. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. The most recent value we have for that is -7 days from 2022. While we will have to wait until the next earnings report to see an update, my guess would be that this value continues to improve as Cava moves closer to achieving economies of scale. Last, let's explore Cava's debt. The net debt to EBITDA is -0.2. Let's remember that the EBITDA is negative, which means that Cava is carrying some debt. This metric is much more difficult to utilize while the company is unprofitable. For a newly IPO'd company, Cava looks decently good. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Cava. It is a restaurant company with a gross margin of 35%. The 5-year revenue per share CAGR is unknown because it has not existed that long. We will use 3-year data in its stead. The 3-year revenue per share CAGR is 18% and the 3-year free cash flow per share CAGR is -27%. Nothing surprising here, but would expect to see revenue per share growth above 20% for such a new company. For return on invested capital of we will put in a 0%, and for cash conversion cycle we will use -7 days. Concerning debt, a net debt to EBITDA of -0.2 again reiterates that Cava isn't profitable and carrying debt. So from a fundamental standpoint, Cava has all of the hallmarks of an unprofitable growth company, although its revenue growth is not as high as I would have hoped. Now let's switch our attention over to valuation. Cava isn't profitable when compared with the S&P 500 with a ratio of -2.5. The price to earnings growth, or PEG ratio, is incalculable given the unprofitable nature of Cava and the lack of analyst coverage to generate earnings estimates. In summary, Cava is a new restaurant trying to carve a piece out of the competitive fast casual restaurant industry. They have decent revenue growth and have modeled themselves after one of the most successful restaurants in Chipotle. However, there is still much for them to prove and only time will tell. In the meantime, we will add Cava to the watch list and watch their growth closely. Many thanks for watching. What do you think about Cava? Do you have enough information to invest, or do you require a longer track record to evaluate? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.